Welcome everybody. Thank you for joining us at this public lecture community education seminar on tax. I first would like to acknowledge, as we always do here at the law school, that we meet on the traditional lands of the Wurundjeri people of the Kulin Nation, and we pay our respects to their elders past and present. Many important things in the ancient culture, possibly franking credits were not one of them. This is one of the community education events of the tax clinic program that has been set up here at Melbourne Law School. Today's event and the Q&A are being recorded so that we can share the information presented today on our website. If you would prefer not to be on camera, if you could please let one of our cameramen know or our staff know that. The tax clinic program was something that was announced, in fact, by both sides of politics. The Melbourne Law School Tax Clinic is a supportive, inclusive, student-run clinic where unrepresented taxpayers can access free tax advice from Melbourne Law School students. Our students are supervised by a dedicated clinic supervisor and experienced tax practitioners. And you'll be hearing from a very experienced tax practitioner this evening. My name's Miranda Stewart. I'm a professor here at the law school and I'm a director of tax studies and tax group at the law school. We're really delighted to be setting up this new program here at the school. So the clinic is intended to help unrepresented taxpayers meet their Australian tax obligations and to assist in engaging and dealings with the Australian Tax Office. It is generously supported by the Australian Government and volunteer tax professionals. In its first iteration, the clinic will be seeing clients between August and October this year, 2019, and applications for assistance can be made through the Tax Clinic website. They'll be open from the 15th of July 2019. So we start in the second half of this year, and if people want to see someone at the Tax Clinic, they need to apply through the website, which can be accessed from the Melbourne Uni Law School page. So our staff are taking details in the registration area outside. So if members of the audience are interested in learning more, you can also ask them. So this particular free information session, it's one of several we've been offering, will cover a complicated set of questions, the tax consequences of receiving investment income, such as interest, rent and dividends. And the session will also explain what franking credits are and how they work.
We don't want to hear about franking credits.
I'm not sure why you're here if you don't want to hear about franking credits. So following the session, you will have the opportunity to have your questions answered by our presenter, Aldrin da Zilva, who I'd like to introduce. Perhaps you could come forward, Aldrin. I've known Aldrin for many years and we're really very honoured to have him participate in this program. Aldrin is actually the head of tax at one of Australia's leading specialist firms, Greenwoods and Herbert Freehills in the Melbourne office. Aldrin has over 25 years of Australian tax experience advising, I guess, at all levels, both at the large corporate and multinational level and also individuals, and has represented clients in matters tax disputes, which I wouldn't wish upon anybody, but tax disputes in the federal court and in the High Court in Australia. Aldrin is also very knowledgeable about tax policy reform processes and has been involved in many Treasury consultation processes. And we're delighted that he's also been a senior fellow here at the law school for many years. He teaches in our Tax Masters program. He's been recognised as one of Australia's leading tax advisors by the International Tax Review, Who's Who Legal and Doyle's Guide. So thanks to Aldrin for his insights and volunteering his time today, and I'll hand over to him now. There will be time for questions after the presentation within this hour, and we'll finish promptly at 7. Okay, hand over to you now.
Great. Thank you very much for that introduction, and thank you all for attending. It's always very exciting to see such great interest in tax, and so many people with so many questions. I should say in opening that I am a very proud Australian. I came to this great country when I was 8 years old, and I feel so blessed and honoured to be here. It is the best country in the world by far, and as I say, I'm very much honoured and privileged to be a citizen of this country. It has a lot going for it, but one of the things that has always intrigued me is, given the size of the economy and who it is that we have the most complex tax system in probably the whole world. So tackling a topic such as investment income and related expenses, and trying to get across some of the essence of that in the space of 40 minutes is a very big challenge. We do have master's programs that run for 2 years, and Miranda is the head of that and runs a fantastic program, which I'm again proud to be a part of. But there's a lot of detailed information and a lot of, basically runs for a few years, and we still don't end up covering all the material that we'd like to. So I guess with the gravitas of the task ahead of me, I have attempted to try and really demystify some of the myths. It's always very interesting, and it was great to see tax receive such a prominent role, I guess, in the election, and it was also very frustrating, I should say, to actually listen to some of the misinformation out there in terms of the various politicians and the various media personalities as well, get some of this totally wrong. And so you're sitting there as an academic and then as a tax practitioner, almost sort of yelling down the radio saying, well, hang on, that's not quite right. So look, as I said, what I'm hoping to do very quickly is just perhaps run through some various different structures that we do have in Australia, and then really take a very basic example of someone running a milk bar, and just looking at the various different types of structures that might be used, analysing some of the basic tax outcomes of that, and then I will, unfortunately for the gentleman up the top, touch on franking credits, because it is it's again a very misunderstood area, and so for me, part of what I'm hoping to achieve today is to try and really demystify some of these things and give you enough information and enough knowledge to then actively participate in these debates in a very knowledgeable way. I should start with an apology to. I've got a very wide cross-section of people from a very diverse set of backgrounds. For any tax professional sitting in the audience, you might find some of this very basic, and if you could just bear with me, because I have had to deal with quite a diverse audience here. But feel free to ask me some of those technical questions that you might have, and we'll see how we go. So, as I mentioned, what we hope to cover today is just the income tax treatment of certain different types of investment vehicles using a single very basic example. I will touch on dividend imputation, and I'll also touch on negative gearing, so that again, to the extent these topics are ever raised again, you actually understand the basics of it, so that you can participate and fully understand which politicians are actually telling you the right thing and perhaps which ones are maybe gilding the lily a little. So my basic example, and just flowing through the different types of investments you might have. Let's start with a sole trader. A sole trader carrying on a business in their own name. What happens in this scenario is obviously all of the business activities are treated as being undertaken by the individual. Okay. And for income tax purposes, any receipts and expenses all are recorded in the individual's name. Very basic example. As you can tell, I've done my own slides. It's not one of my fortes. The other thing you will realise as we're going through this is I'm not sure what it is, but being a lawyer means that I'm not very good at maths. So hopefully you won't pick up too many errors with the math as we're going through it. But here we have Jane undertakes runs a milk bar as a sole trader in her own name and generates gross income of $55,000. Okay. Jane also has certain expenses in running the milk bar of $15,000 and withdraws $25,000 as she's going. Okay. So in this scenario, what happens is Jane reports the $55,000 in her own personal tax return as income. She gets to claim a deduction for the $15,000 of expenses. And so she then recognises a profit in her own name of $40,000. Okay. That $40,000 is taxed at Jane's marginal tax rate. Okay. And there are basically varying scales. As you earn more income, you pay higher amounts of tax. The ATO does have some very useful material on their website, and they have some tax calculators you can put the numbers into, and they'll spit out what your estimated tax is if you don't want to work through the tables yourself. Based on applying the marginal tax rates and excluding the Medicare levy and the Medicare surcharge and things like that, largely again going back to my comment about maths being not strong and making it very simple, Jane ends up paying tax of $4,547. Okay, I want you all to remember that number, magical number. If Jane runs this business in her own name by herself, what's the amount of tax she'll pay? $4,547. She's made $40,000, okay? Remember that number, because what I would like you to try and appreciate is, well, how does that number change depending on the different types of investment vehicles one might use, okay? Does it have an impact, okay? And so we then ask the same question, well, does it have an impact if Jane ran this business through a partnership? Well, what's a partnership? It's a association of persons carrying on business in common with a view to profit, okay? A partnership is not a separate taxed entity, okay? It's not taxed in its own right. The partners in the partnership are taxed, but the partnership itself is not taxed, okay? And that's a very important point to bear in mind. We then have a look, and this time Jane, again, my wonderful diagrams, we have Jane and her brother Simon, this time running the milk bar, okay? And I've assumed that this time, because there's two of them running the milk bar, that the income that one might generate is double. Okay, so Jane and Simon run the milk bar as partners in a partnership. Okay. This time the milk bar makes twice as much as the $55,000. You might remember the $55,000 was what Jane generated as a sole trader, 2 of them, 110, I think that maths works. And there's twice as much allowable, or twice as much expenses, so $30,000 of expenses. And so the partnership generates net income of $80,000, okay? Being the $110,000 gross income that's assessable, less the 30, gives me the 80,000. What happens under a partnership? As I mentioned before, the partnership itself is not taxed. Each of the partners has an entitlement to a portion of the net income of the partnership and is taxed in their individual name, right? So what I've told you to assume here is that the partnership is an equal partnership, and you can have some unequal partners, and you can have common law partners and tax law partners and all these more complicated scenarios, but I'm just trying to keep it simple here. So Jane and her brother share in the partnership income on a equal a percentage basis. So what happens here? Jane has to include in her assessable income, in her taxable income, $40,000. Okay. Jane again is taxed at her marginal rate of tax on that. And so what does that mean in terms of the tax Jane pays? Lo and behold, it's the same number, 4,547. Okay, the 4,547 that Jane paid had she been a sole trader generated the income herself. Okay, so what we've determined there is sole trader partnership. Basically, the tax treatment doesn't change. Okay. My next structure, a trust. Okay, this is pretty common amongst small businesses. Okay, what happens here is that the trustee has the legal entitlement and ownership of the assets and is responsible for managing the trust on behalf of the beneficiaries, right? And again, it's important to note that generally the trustee doesn't pay tax. Okay? The beneficiaries of the trust are generally entitled or made presently entitled to the income of the trust, and it's the beneficiaries that then wear the trust burden. And there's basically a discretionary trust or a unit trust, and then this discretionary trust, the trustee has a unfettered discretion as to how they allocate income and to whom the income gets distributed. With a unit trust, that's generally based on the proportion of units that you own. Okay. So what happens in this scenario? Again, let's assume Jane and Simon running their milk bar, this time through a discretionary trust. Okay. Again, the milk bar generates $110,000 of income, has expenses of $30,000. Okay. And the trustee of the trust is Terry, and Terry at the end of the year is required to distribute the $80,000 to the beneficiaries. Right? So basically passes a resolution and the income gets distributed. If Terry doesn't pass a resolution to distribute the income, Terry does pay tax, or the trustee is taxed at the top marginal rate. Okay. But in this circumstance, we're told in this example to assume that Terry decides to distribute $40,000 of the $80,000 of income to each of Jane and Simon. Okay. So what happens in that scenario? Jane gets a trust distribution, needs to declare that in her tax return, and again has to pay tax on her marginal rates in terms of that trust distribution. So she gets $40,000, applies the marginal rates, and what does she end up paying? $4,547. okay? So I guess again what we're trying to demonstrate here is that the use of different structures doesn't necessarily result in any different taxes. Remind me to come back to a trust structure, because you will have, and there are a number of listed trusts in the market. One of the most frustrating things for me is when some media outlets will compare the taxation of a trust with the taxation of a company. Can you do that? The answer is no, because you're comparing an apple with an orange, right? The trust, remember here, the trustee is not paying the tax. It's the trust, it's the beneficiaries of the trust, okay? It's Jane and Simon paying the tax. You're not looking at the trust as a taxable entity. So if you're then trying to compare that with an entity that does impose tax on the operational aspects of the entity, then you're comparing apples and oranges, okay? So again, some very prominent reporters get this wrong. So far we've looked at a sole trader, partnership and a trust, okay? And then what we've worked out is that the partnership and a trust effectively flow through vehicles, right? The taxation burden sits at the partner level or the beneficiary level, and there's really not a lot of difference between a sole trader and effectively those persons sitting at that higher level. The entity itself is not subject to a tax generally. There are circumstances if the distribution isn't made, etc. Compare that to a company, okay? So we now move across to a company. A company is a separate legal entity and is required to pay tax in its own right on the income that it generates. And there's effectively two tax rates, the 30% and a more concessional 27.5% for smaller entities with, I think, a turnover of less than about $25 million. Okay. For the purposes of the illustration, and again, because maths is not my forte and the numbering gets very difficult, I've used examples based on 30%. Okay, but just note that with the numbers we're talking about, the likelihood is that it's going to be 27.5%. A company also doesn't get the tax-free threshold and there's no capital gains tax discount, right? So there's no marginal rates, it's a flat rate. Every dollar the company gets is taxed at this rate, at the corporate rate. So now let's have a look at what happens. Jane and Simon decide to run the milk bar through a company. The milk bar generates income of $110,000, there's expenses of $30,000, and there's income, a profit or taxable income of $80,000 again. Okay. What happens this time around is that the milk bar Proprietary Limited or the company has to pay tax in its own right. Okay, so for the purposes of this illustration, I've assumed a 30% tax rate, so it obviously pays tax of $24,000. Okay. The company might pay wages or salary to Jane and Simon and can get a deduction for that. And again, for the purpose of this illustration, because it will enable me to explain all about imputation and franking credits, I've assumed there's no expenses going through there. So, you'll remember that if Jane ran the business herself, generated $40,000, the tax rate was that magic 4547. Ran it through a partnership and derived $40,000 of partnership income, 4547 if she ran it through a discretionary trust and received a distribution 4547. Through a company, she'll end up paying on her $40,000, $12,000 in tax, okay? Being half of the 24, right? So the 24,000 is basically the tax on the 80, right? Here we go. Franking credits, dividend imputation, and again, the furor that preceded the election. So much misinformation out there, and again, quite fascinating and frustrating. So what is a franked dividend? A franked dividend is a dividend paid from a company from after-tax profits, okay? And so you've effectively already paid some taxes in the company, and then you're paying a dividend from that after-tax profit, okay? It's a fully franked dividend if the entire full rate of tax has been paid on it. Sometimes you might receive a partially franked dividend. Okay. It's important to note that if your tax rate is above the corporate tax rate, where you receive a dividend, you'll be required to pay what's termed top-up tax. Okay. Where your effective tax rate is below the corporate tax rate, you will, or super funds and individuals will receive a refund of the franking. Okay. We will run through my example here to make sure it all comes through. So again, we had Milk Bar Proprietary Limited that made the profit of $80,000. Okay, paid tax of $24,000 at the 30% tax rate, even though the only reason De Silva has used that is because maths wasn't great for him and it really should have been 27.5, but we'll bear with him as we're going through this. And so of the 80,000, obviously if 24,000 has been sent to the taxman, the after-tax profit is only $56,000. Right? That's the amount of cash left in the company after it has paid the tax. Okay, so it had 110,000 income, paid 30,000 of expenses, you might recall, right? Down to 80. Then it had to pay some monies to the taxman, being 24,000, and it's left with, after tax and after all the expenses paid, an amount of $56,000. Okay. And what it now does is it pays Jane 50% of the profit or the after-tax dividend. Okay. So Jane receives what's termed a fully franked dividend of $28,000. Okay, so remember what a fully franked dividend was? It's a dividend where that dividend has already borne some taxes, okay, at the company tax rate. And so what happens here is Jane receives this fully franked dividend of $28,000 because it has already borne some taxes at the corporate level. That corporate tax flows with the dividend, okay? And so Jane also receives this franking credit. So the franking credit is effectively the tax that's been borne by the company, okay? So what Jane gets is $28,000 in cash, okay, being half of the 56, plus a franking credit of $12,000. What Jane has to put in her tax return are both of those elements. Okay? And so Jane is required to show in her tax return the $28,000 cash that she's received plus the $12,000 franking credit. And so that then gets Jane back to the $40,000, okay? A magical $40,000. And what does Jane then do? Well, Jane then needs to calculate taxes payable on that $40,000 based on her marginal tax rates. The tax that she's supposed to bear on that $40,000 is $4,547, okay? But the company has already paid $12,000 of tax, okay? And so what Jane then gets is a $7,453 tax refund from the tax office. So what the dividend imputation system is trying to do is trying to effectively put you back in the position, or put Jane back in the position that she would have been in had she been running this in her own name as a sole trader, effectively. It assumes that the taxes payable at the corporate level, there's already one level of tax that's been collected, okay? If Jane ran this business in her own name, we know she'd get $40,000. She would have to pay $4,547 in tax. What the dividend imputation system is doing is putting Jane back into that position. It's giving her a credit for the taxes that have been borne at the company level. And so obviously the debate and the discussion is then around, okay, well that works really well, and this is part of the issue around, well, if there was a person running their own business, this all makes absolute sense, right? Because you've got the tax system effectively trying to put you back in the same position you would have been in had you run this business in your own name. I guess where it gets a little bit more complicated is where you are effectively investing in, say, a listed entity, right? Where obviously that's not your own business, and then it's a question about whether or not there is the right amount of taxes that have been paid on that. Now, on one hand, you would say, well, the tax man shouldn't be too greedy. If he's collected one payment of tax, then he should be happy with that. On the other hand, you might say, well, hang on, no, there's people that effectively are, receiving these amounts and getting refunds that perhaps they shouldn't be entitled to. We'll leave it to you to decide what the right answers are to some of these things, but for me, the key thing is to understand what this system is trying to do. And there's a lot of merit in what it's doing, okay? Let me just explain to you why. Let's say we didn't have a dividend imputation system, right? What happens then? Okay, so without a dividend imputation system, let's have a look at what happens to that dividend. Well, this time Jane gets a $28,000 dividend, being the after-tax cash, the half of the $56,000, right? And what had happened is then Jane would be subject to a second level of tax. She'd have to pay tax on that $28,000. And again, applying the marginal tax rates, there'd be an additional amount of $1,862 payable on that. And so in this circumstance, what you're seeing is that $40,000 is effectively being taxed twice. First in the hands of the actual corporate, and then secondly at an additional amount in Jane's hands. Australia is one of the only countries in the whole world that has a full imputation system. That is correct. Okay, and part of the reason why we have a full imputation system is to avoid the double taxation of these profits. What does the rest of the world do? Well, the rest of the world, or a large chunk of it, such as the US, etc., exempts that dividend. Okay, so if you receive a dividend and it's effectively subject to tax, you don't have a further level of tax on top of that. Otherwise, again, you'll have this double taxation problem. So again, you will hear some murmurings and some politicians perhaps saying some wrong things here. But as I say, the trick is just to understand the basics, what the rationale is behind the system, why it does work effectively, and effectively what it's trying to achieve. Okay. I might pause there and take some questions, if I may, before I get on to the negative gearing aspects.
Explain that last little bit about other countries like the United States. I didn't quite understand what they do.
So what they do overseas is so as to avoid the impact of double taxation, what they say is this $28,000 that Jane gets, right? So the 28 after tax that Jane receives is not subject to any further tax. It gives you a credit or an exemption from a further level of tax on that 28,000. And so what effectively that means is that if you invest, what you're subject to is a 30% tax rate. No refunds, no additional tax. No problems. Lots of questions. This is fantastic. Great. Maybe I'll start down the back first. Maybe down the back. Sorry.
Like US, is their personal tax rate at 30%? Is it is it 10% or 50%?
Yeah, okay. It's nowhere near as we have some of the highest tax rates in the world in Australia. Most of the other jurisdictions are much lower, and they are tending and trending towards reducing their tax rates. The difficulty for Australia is we have a fantastic social system, and what underpins that social system is obviously the tax system. And so it's weighing up getting that right balance between still incentivising people, but still enabling. That's one of the beauties of this country, right? No one really goes hungry. And so it is weighing up that right balance. So we do have, some of the highest taxes in the world, but, arguably some of the best social systems in the world. Gentleman in there.
Okay, could you go through an example of a retired investor who doesn't work, has no business, but has got assets invested and receives, say, $30,000 of dividends?
Absolutely. So look, I guess what I would do there, and happy to do that with, let's assume my company example again, right? But this time, let's assume that the shareholder in this company is not Jane. It's a retired pensioner who doesn't generate any other income. And that person owns 50% of this company, right? The tax outcome is exactly the same as Jane's. So what happens in that scenario is this person, let's call this person Bob. Bob owns 50% of the shares in this company. Bob gets a fully franked dividend of $28,000. With that will flow the $12,000, and then Bob again will apply his marginal tax rate and effectively, get a tax refund of the 7,453, right? That's in the standard circumstance. So I should explain that it gets a bit more complicated where Bob is in, say, pension mode, has his own pension fund or his superannuation fund and is in pension mode, right? In which case, Bob's marginal tax rate, and let's say the super fund invests in this milk bar, okay? So the super fund decides now, and I'm going to change the facts around a little bit more, super fund now decides to invest in Milk Bar Proprietary Limited, owns 50% of the shares, gets a dividend of $28,000. Again, there's a franking credit of $12,000 that flows with it. Because Bob is in pension mode in terms of the super fund and the distributions, the tax rate that Bob has to pay on that is zero. And so what happens in that circumstance is Bob will get a full refund of the $12,000 in the tax that's been paid at the corporate tax rate. Sorry, there was a question up the front end and I'll then come back to you if that's all right.
I'm just interested in, earlier you spoke about the misinformation in the latest debates on the franking credits. In short, could you outline what those the most serious misinformation topics were?
Yeah, so look, I think in short the thing that really got me was that there's some sort of mischief here, and effectively there's some sort of rort with the system. Now, for me, I don't espouse to that view. In my mind, and take the pensioner example. Just putting it on the table. I mean, if Bob is in pension mode, and we as a community have said to Bob, you know what, you've worked really hard all your life, you've saved up money, you are in, our system effectively enables Bob to generate income without being taxed on it because he's in pension mode. The fact that he's getting a franking credit refund is not a rort. It's not some problem with the system. It's the fact that we decide as a community that we are going to tax Bob in that way on the pension income that he's deriving. So for me, the issue was that there was a fair amount of information about, and part of it was political, but really suggestive of there being a problem with the imputation system. It's not a problem with the imputation system. It's actually, if we've decided to tax pensioners in that way, then, perhaps the problem is somewhere else, if there is a problem at all. But yeah, as I said, it was that's probably just one of the examples, but a few others. I hope that answers your question. Sorry, there was a question in front of me here, or a couple of...
The aim of imputation is to stop income being taxed twice, and imputation relieves the shareholders of paying tax on their shareholder income. Probably an interesting scenario for a class in taxation law might be to consider not taxing companies but taxing the shareholders. And given that all companies are owned by shareholders, the government is still getting its tax. Do you have any initial thoughts about that?
I think that's a really interesting pathway. Most of the debate and the political moves are actually the other way, to tax the partnerships and the trusts as companies, as opposed to the flow through of the companies. I mean, I think you end up effectively with the same outcome, I guess, is what the imputation system produces. So look, I think that's a worthwhile debate and discussion to be had. There are again some very for those that do practice in the area, you'll there are some limited liability companies and some LLPs and LLCs and all these other weird and wonderful structures overseas that do give you that exact result. You can check the box and effectively have a flow-through treatment and taxation treatment. That isn't something that's available here, but yeah, effectively the imputation system, I guess, does that already. And one of the ways in which you could deal with the double taxation is by making it flow through. Yeah, absolutely.
In the company example, if Jane and Simon took their $40,000 each as wages, how would that change the tax treatment?
Thank you. A great question. And again, what would happen there is that the company would get a deduction for the payment of the 80,000, right? So my company goes from making a profit of 80,000 to breaking even. Why? Because it's paid out the 80,000 and there's now zero profit. So no corporate tax, and both Jane and Simon would pay taxes in their own right on the $40,000 income that they received. So in that circumstance, Jane wouldn't get the refund, but she wouldn't need the refund because she derived $40,000 of cash and end up paying tax at her marginal rate of the magical $4,547. And that's exactly what, I guess the imputation system and what this system is trying to do is get back to effectively that situation. But there's another way you can get there, which is exactly the question and the scenario that you put to me. So thank you for that. Any other questions? Fantastic. Down the back.
Would you be game enough to say who got it 100% right prior to the election, the dividend imputation, and who got it 100% wrong?
Look, I'm not game enough to say that because that is a very difficult. I have actually. What I am game enough to say is I am a swinging voter, personally. And I also do a fair amount of work with Treasury around some of these things for both sides of politics and just really do try and get, to try and further refine and better our tax system. I think there's a fair bit of work to be done no matter who's in charge and some real challenges, to be quite frank. I mean, again, I'm also happy to share with you perhaps, what my views are on how it can all be simplified, to be quite frank, because it is something that does, as an academic and someone that practices. I mean, for me, the simplest way of dealing with this and simplifying the whole tax system is to reduce individual tax rates, reduce corporate rates, and increase the GST, right? That is, and you talk to most academics, most tax professionals, that's where we have to try and get to. Why? Because in that way you take out of the system some of the noise and the difficulties with all of the different tax rates, and you're taxing consumption. Okay? And it's the way that the rest of the world goes. But it's a very difficult political thing to try and actually get through because it's a big change and people are averse to change. But, it's sort of, I don't know that I've fully answered your question, and I've tried to in Yeah, so look, I do have some views on the black economy as well, but in terms of, and I know you've probably heard from Michael Andrew, I think, there's a lot that, does need to happen in terms of improving the black economy. But as our system becomes more cashless, and the cash comes out of it, I mean, you just need to look at the younger generation today. I don't think they have a sort of dollar note in their wallets. It's all about the card. So once you've got the cashless economy coming in, it's very difficult to actually, the black economy does, I think, sort of reduce. But, you know, again, I think there are some different ways in which you can also tackle that, and I guess you know, Michael has probably mentioned some of the ways that you know, he's talked about that's done overseas. You know, the relevant accreditations, making sure that you know, certain tradespeople are accredited and the like. And so, you know, I think that's a slightly different issue, but you know, I guess for me, there's a, you know, the structural solution is somewhat different. Sorry. Just down the...
A number of economics experts have proposed replacing the company tax with a cash flow tax. What is your views on that subject?
Sorry, the company tax with a... Yeah, so look, again, I think that's a little bit more difficult to do because, you know, the accrual system of taxation and accounting is it will impact certain companies and industries and taxpayers very differently to others, and will create further sort of disproportionate outcomes. So in my view, I mean, I don't think it's the mechanisms as such that are there that are too problematic. You know, I think one of the things I have heard of that again is perhaps, you know, worthy of consideration is levying taxes on your accounting profits. You know, for me, that is not such a bad thing to explore further. And why? Because you might get some movement at the bottom end, but there is a real pressure on large companies to make sure that their profits are very high. And so what you might sort of miss out on terms of, you know, some of the discretionary accounting treatments people might make at the lower end, you'll pick up at the top end. Sorry, I should probably move on a little. I will come back if we don't run out of time, but I just want to touch on very quickly negative gearing, and then I will answer a couple of those questions. So what is negative gearing? Well, it's where you effectively borrow to invest in an asset, and the expenses that are associated with that asset exceed the income that you generate from that asset. Okay. And so why do people negatively gear? Well, partly because you can offset the income that you might generate from other sources against, I guess, some of the deductions that you might get on holding some of those assets. So here we have again another simple example. Sam goes off and buys an investment property for $550,000 and borrows $500,000 at an interest rate of 5%. Okay. Interest payable is $25,000 per annum, and Sam leases the property out to a tenant for $440 a week. So Sam receives rent of $22,880, has a number of expenses totaling $10,000, and so we then have a look at, well, what happens there. Sam's total deductible expenses represent the $25,000 interest plus the $10,000 costs. So Sam's deductions are $35,000. Sam receives rent of $22,880, and so Sam has a net loss of $12,120. Let's assume that Sam also then derives employment income of $63,000 from basically other employment, in which case then what happens is Sam's total taxable income is $63,000 less the deduction that he's made on the rental property, and therefore gets taxed on the $50,880. So, why does Sam do this? Why do you if you think about what's going on here, right? Sam's getting a deduction for 12,120. What has Sam done? He actually paid out $12,120 in cash, right? So, one of the things that again gets me, this is not some magical loss that's appeared from somewhere. There's a real outgoing, okay? A real cash outgoing that has generated this tax loss. Sam has paid $25,000 to the bank that's lent him the money, and Sam has also paid the $10,000 of expenses. Okay, so he's actually paid $35,000 out. So I guess again, one of the things that, you get on the negatively geared property, you get the deduction. Why? Because you've actually incurred the expense. You've paid the money out, okay? And that seems to, unfortunately, sometimes again get lost in the debate on this topic, okay? There's an actual outlay here. Why does Sam do this? Well, Sam is betting on the capital gain, right? Sam is saying, I'm happy to incur this loss and I'm going to keep incurring this loss because I know property prices are going to go up and I'll be able to sell it for more than the 550. And also what Sam will want to do is obviously try and recover the expenses that he's incurred and the losses that he's made along the way. So that's effectively what Sam is doing. But again, the one issue for me is just, people sort of tend to deal in this topic on the basis that you get this magical deduction. No, it's an actual cost and outlay, and Sam has paid someone else this money. So then think about whether or not he should be entitled to the deduction or not. Sorry, lots of questions. I've got about 2 minutes, I think, Miranda, but I'm happy to take some other questions on this or any other. Oh, sorry, that one? Sure. So, I guess just on that, you can, offset, you can negatively a lot of things. There are some, so things like any non-commercial, there are special rules to deal with things that are non-commercial losses for certain hobby farms. Government has introduced certain measures to try and, cut down on the potential availability of certain losses where they're not, business losses per se. So it's also important to bear that in mind. Question?
To what extent do you see negative gearing as contributing to inflating property values? Because if you can then offset it against income, then you're prepared to pay more than somebody, who may be purchasing it for purposes of living in such a...
That is, that's a really valid and important point. I mean, that is the ongoing debate. You've got the first home buyers coming into the market trying to compete with, those that are buying it for investment purposes, and the first home buyers effectively don't get a deduction for the interest costs and the like. And that is a real, that is the debate to be had. On the flip side of it, just note that obviously if you sell your principal place of residence, make a gain, there is no tax on that gain. It's tax-free. Sam sells the rental property, he'll be paying tax. He'll get the CGT discount, but he gets taxed on that gain. And that's, I guess, the quid pro quo. It's trying to balance that up, but, that's effectively where the debate should be. And then it's about, well, whether or not you should be giving further and additional grants to, first home buyers to help equate that up, and how we should spend the social.
Do you see capital gains tax as a separate entity to negative gearing?
Sorry, how so? I think they are related, and that's why it is the case that you don't get the that you don't get the deduction for the holding costs if you're buying it for your own principal use. You're not getting the holding deduction for that, but the flip side of that is you're not assessed on the sale of your principal place of residence. So for me, I think they are connected, and that's why, Sam's getting the deduction and effectively can offset or is taxed on the gain. Any other burning questions? I've probably run out of time, but look, I did want to thank you all very much for your attendance today. Thank you so much for taking an interest in tax. Hopefully I have managed to dispel some of those myths, but once again, thank you so much for taking the time out of your busy days to come and learn a little bit more about tax.
Providing Aldrin with a little something.
Oh, thank you.
To keep him going. I'm sure it's non-taxable. And thanks again, Aldrin, so much for talking to us this evening. And I hope you've all learned something. And if you want more information about the clinic or the community education program that goes with it, ask our people outside and keep an eye on the website. Thank you.
Thank you.